We need to have a discussion about stagflation and whether the economy is currently in it right now. Today, we'll talk about everything to do with the earnings season for the week ahead, what's going on with the darkest pool transactions as big players start to sell into the Friday close, and of course, why this matters for us as a positive or negative gamma environment on options. More importantly, though, Apple's weak. Will it get weaker? Bitcoin's starting to struggle throughout the weekend. And of course, many stocks are finding their way to previously traded zones. So as bulls and bears fight it out at the most important level that we've been looking at now for 2 days, should we also be looking at world central banks? Because policy is getting out of control in Japan, and we need to talk about it. Join us as we cover stocks, commodities, and cryptos for the week ahead. Well, welcome back, everybody, to the special weekend edition of The Daily Show. Today, we're talking macro data, lead indicators, and of course, the hottest charts for the week ahead, whether you're an investor or trader. If it's your first time here and you want to educate yourself better on how markets move and how they all correlate with each other, remember to subscribe and smash that bell icon. Well, let's get into the first topic, the dreaded stagflation. A problem with economies that often many of us kind of worry about, and it's pretty rare, and we've only ever really seen it in the 1970s. Now, the question is, how do we get to stagflation? Well, generally, we need to see economic growth slowing, inflation up, and unemployment also on the rise. Now, at the moment, we certainly have one of those problems, which is, of course, inflation up. But do we have the other issues? Let's take a little closer look at whether we're really in stagflation. So if we take a look at the GDP growth over the last 4 quarters, it's actually been very, very strong for the US. And it's a huge reason why the markets are recovering, led by, of course, the AI robot companies. On top of this, we also know that we had one bad GDP result of 1.7%, but it's still increasing. And in general, we're not seeing like a really stagnant flow. In fact, Goldman Sachs actually already estimated that this could be a possibility and that we're moving into a period of very sustainable growth, including the GDP moving forward. So if we are in stagflation, what should we be investing in? If we're not in stagflation, but we're in a rising interest rate economy, does it really make any difference? Well, as you'll find out, the actual same investments that tend to do well in stagflation also do well in rising inflation. And we do have rising inflation right now, as shown by this chart that's starting to show some spikes and some increases across the board. And there's a couple of reasons why this could be. In stagflation, though, what performs the best? Well, of course, it's gold, it's commodities, and actually value stocks do well as well. Also, existing buildings. We've already seen that going on. It's not so much the land underneath them, but if you have a nice house and it's been built to a quality standard, then of course, as everything else, including commodities, goes up, what ends up happening? Your house rises. So in general, if we're in stagflation, then you generally go for these types of positions. If we're in rising inflation, it turns out you also go for these types of positions a lot of the time. So I think it's very, very key to keep in mind if you're worried about that particular thing, that this would be what you're looking for. Now, why are we seeing this inflation? Well, in my opinion, it's underproduction in the oil industry and underinvestment in commodities. Recently, a Rio Tinto CEO came out and said he's incredibly concerned about rare earth minerals and metals and underinvestment since 2016 in all of these things that we need for this supposed green revolution. And you can see energy transition investment is just on the rise. So what's going to happen? Well, ultimately, we're going to burn more oil. We're going to need to go and do more exploration. And we're just not going to have enough minerals and metals coming out of the ground if every country gets on board this particular train. And that's leading into something we've been discussing here on the channel for at least 2.5 months, which is, of course, that whether we have inflation or not, we are in geopolitical issues as well, which tends to spike all of those particular areas. And I think this is a twofold and two-pronged attack on why we're getting so much strength in the commodities markets in particular. So where should we be looking? Well, here's the pullback so far, and of course, we've got the little bit of recovery. Are we cheap or are we expensive on the S&P 500? Well, we're not quite back to what I like to get, which is, of course, in those 17s. That is very much a smiley face area for the dollar cost investor. But we are still pulling back a little bit. Now, in general election years, as you're about to find out, we could get a little bit more, but we face one of the toughest areas from the bulls and the bears. And as we reported on our previous video, we expected 5,100 to be a big battle zone, which even with the amazing results from Google and Microsoft, it still wasn't able to break. And we might have some little inklings right now as why that is. You'll see here that trend strength is actually dropping across some of the smaller caps and some of the other pairs of the market. So here's the S&P 500 versus the S&P 400 versus the S&P 600. And you'll notice that they're not exactly all going up in a straight line like you would usually expect in a really robust market. That's not what we're seeing at this stage. Bull market behavior checklist. You can see here that the New York Stock Exchange plus NASDAQ new highs to new lows is not exactly coming along with this current market rally. And that's kind of normal. I mean, at the beginning, you usually see the big gamma stocks go first, which are those semiconductors and big tech stocks, and then the rest come through. The next question you want to ask yourself is, when we're correcting here, is it actually a crash or a correction? Well, in many ways, you just want to be looking at it from a perspective of whether we're in financial stress. And of course, you can see when we're in serious financial stress, such as 2008 and 2020, and also that little bit of a sell-off that happened during 2023 when we had, of course, the regional bank crisis. But on top of that, we don't really have a stressful market right now. And you can actually see here, if we're to believe these figures, consumer financial stress is falling to the lowest in a year. Yeah, that's strange, but it is. And according to at least the results out there of the people on there, that's what we're seeing. So therefore, what do we want to be looking at in this pullback, in this correction? Well, we've talked about this a few times. We believe that data, therefore AI, is going to be a huge play, of course, moving forward. Get ready for the land of the IPOs, I feel, in 2025. They probably won't IPO in 2024 because of the election year, but I'm sure 2025 you'll get a lot of AI IPOs going wild in the markets. And then, of course, we've got the geopolitical tensions. Now, that leads into some markets around the world. My market here in Australia, of course, many minerals, metals. Most people around the world know that we're a big desert, really. So we've got those types of things, in particular iron ore. And of course, then you've got Canada, and you've also got the United Kingdom. So we've already talked about this quite a few times, but any of these strong indices that have those particular areas in them, including financials actually at the moment, are all in strong bulls. And they've actually been outperforming the S&P 500 since we've started talking about them a lot. Now, gold's also in a strong bull market, as we know, and emerging markets are becoming interesting. So you'll notice here the short term is starting to turn, the long term horrendous still. And that's what we've seen also in the Chinese market in terms of short term has been improving, long term has looked horrible, and look at the breakout we got last week. Another way to look at this, if you're a first-time viewer of the channel, is to look at the Vanguard Total Stock Market ETF versus the Vanguard FTSE All World ETF. And what we're starting to see here is a breakdown where basically the US is starting to look a little bit worse than some of the places in the world when you're talking about rising inflation markets. And also you're talking about, of course, anything to do with rotation and flow into those cheaper areas. I'll try to get a chart for you guys just to demonstrate how much cheaper in terms of PE ratios you're looking at in something like the FTSE, the Chinese markets at the moment, or really even the Canadian market at this stage. So let's have a look here at the All-Star charts, high versus lows breadth heat map, to try to get an understanding of whether this current rally that's been pulling us up to 5,100 is healthy. So it's a little bit tough to sometimes see this, but actually there are a couple of small caps that are starting to show a little bit of signs of distress. Percent of 1 month lows, the crappy companies actually ended up going down while the market's going up. The good ones still held through, especially KRE, because KRE is really riding the Russell 2000 at this point. But in the undercaps here, anything that has like no earnings, which 37% of the Russell 2000 pretty much doesn't make any money, they're starting to struggle a little bit. So you'll notice that we went from being really negative the other day to back down, even though we've been recovering. So a few days ago, we were looking a lot better than what we were just 24 hours ago in terms of that 5,100 zone. So it's clearly a big fighting point. And underneath, that's the one little inkling that you're saying, well, maybe there's a little bit of weakness. This is another one, though, you'll be looking at from the bull and bear perspective. The Zweig breadth thrust obviously being a very, very good read towards the bulls. If we do end up getting one of these next week, which will be when it'll go off if it's going to, then you've got to keep on side of the bulls. The stats are insane when it comes to these. And we already saw one of these last year, which led us into thinking we're going to go into quite a lot of strength. And of course we did. Let's have a look under the hood though. What was doing well during the Friday trade? Well, we had basically a mixture. I would say there was nothing here that was a standout in either way. Of course, clean energy finding a little bit of a dead cat bounce. Semiconductors finding huge strength thanks to NVIDIA coming off that beautiful 61.8 golden fib that we'll look at later on. And the 5-day rotation actually showing us that semiconductors just came back big time. Those last 3 days of trade, thanks to the decent earnings throughout some of these big tech stocks, got everyone back on board the bull train. What might surprise you, though, is when you have a look over the last year of results, that you have financials sneaking their way through here. Now, if I actually had a 6-month chart, you might notice that this financials line is very impressive. And it's now the best performing 6-month rotation. And that's a great sign for bulls. Now, the reason, there's twofold here. I think that financials are not only making more money because, of course, higher interest rates gives them more margins, but on top of that, I think it's loose lending. I think credit expansion is starting to come through. And of course, whether you want to believe it or not, it's kind of politically charged on both sides. So what's going to happen is you're probably going to see credit expansion go through the next couple of years. And it seems like we've learnt no lessons since 2008. You watch, guys, it's going to get even more wild out there. We talk a lot about this on our Monday Open show. I have rants about it because, of course, I think it's kind of sick. But it is all happening in front of our eyes. And this shows you that for the time being anyway, it will be better to be possibly a bull in markets and buy the correction dips, because if they're expanding the debt and they're expanding the credit, then that usually leads into a bit of growth. Let's talk about S&P 500 from the perspective of the real market. Then we'll go through the futures market and what are our best and worst case scenarios. So we've talked about it a few times. The 20 weekly moving average, I love the mean reversion. And you always generally expect to bounce here. You got to bounce last year here. You got to bounce this time here. You get a bounce all the way through 2020. You can go put it on the charts yourself. Now, it's when you get the bounce, you've got to be a little bit concerned about whether it's real or not. Now, a dollar cost averager, you're going to smiley face here and say, you know what, I'm pretty happy with that as my initial entry. But will we get the 50? Now, we got the 50 last year during a bigger pullback that obviously happened and occurred, and actually went a little bit underneath that. This was a perfect level, though. Very nice zone. 42.40 for the buyer. And of course, right now we would be looking at about 4,700, which makes a ton of sense as well if it does end up playing through. How will you know though? Well, we'll have to go back into what we call a negative gamma environment. And we're actually already almost moving into positive gamma. It's kind of teetering on the edge on Monday, Tuesday next week. So where does that happen? Well, 5,100 is a positive gamma environment. If we push through there, we're probably going up to somewhere just under 5,200 for the S&P next week. So day trade is going to be looking for that bust of 5,100 and hold through the session. And of course, it's also a VWAP level, which means that it's, again, a resistance zone. Now, when we're talking put supports on the Monday and the Tuesday of trade coming up, we're talking 50-50. So we're kind of trapped within this little level. We're waiting for these earnings. Clearly, earnings is what's kicking it in. And if the market comes down to 50-50, there's probably some bull sitting around there, similar to what we saw last week where 5K and 50-25 had the bulls. And if we manage to get through to 5,100, I think it's kind of smiley face for the bulls. Now, bears, you get underneath, of course, this level here, 49.50. You're most likely about to see what we call a waterfall effect, which is where you go through an area where there's not much previous trade. So there's almost no shelves here. So you actually get a kind of aggressive sell that comes in here. Now, it can be quite fearful if that ends up occurring. So you've got to keep a level head. Remember, you're reacting to this. So if you see money flowing from here to here, I like to think of it as money flowing from equilibrium to equilibrium. I teach this in our day trading masterclass and advanced classes. And, I've got to say as well, I really appreciate some of the feedback people have been giving us recently on that. It's not only helping improve the course, but you guys have been, honestly smashing it. It's been amazing. All right, let's move over here to the options levels. And of course, we'll talk about the gamma side. And you'll know here that 5,100 is a big deal. So 5,100, we break through, lots of hedging on the futures. That's going to have to push the overall market up, kind of creating a squeeze. And you'll notice it's not just there for the 29th, it's also there for the 30th. And the 5,200 becomes kind of the next zone for the 17th. So that's the OPEX of the March period. Now, we kind of have like a fight here between the bulls and the bears, and it's between that 50-50 and 5,100 zone. I would certainly be watching out in the smaller time frames and paying a lot of attention to the way it structures up there. In fact, let's just go back here for a moment, go to the 5-minute chart, because I know you guys love looking at the small time frames as well. And if we take a look at this, while of course it was kind of a minuscule win for the bulls, this kind of gives you a bit of an idea of structure. So we have here a lot of structure. It then drops down, then rallies back up to a new high, pushing the 5,100. So where are you going to be looking next week if you're a bear on the intraday? 50-70. If the market takes that low, what does that tell you? It tells you that maybe it's actually found resistance. So I think 50-70 is also a key level that you'll be wanting to look at, where rallies on that market are most likely going to be met by sell demand. It's all about finding your edge in charts. Of course, your general edge on indices should usually be bullish. That's just the truth. It's statistically inbuilt into indices to be better off to be bullish. But if you're going above the 51, kind of 15 zone, that's going to be quite bullish next week. But if you're getting below 50-70, I think that's where the bears sit for the market for now. Now, what about the CTAs? Are they coming along with the bulls or the bears? Well, as we expected, the 20 weekly moving average has got them a little excited. They're starting to buy off that zone, but it's not incredible acceleration. So whether you're looking at the NASDAQ, the S&P 500, or anything else, they're all going to be showing slight levels of buys. I thought for the weekend, I'd also include things like Brent, which is also stabilizing. So Brent looks pretty good still. Gold, which has come off its highs, but seen a spike on the Friday trade. And of course, copper, which is to the moon. CTA is absolutely loving copper, and I've got to say I'm kind of loving the move, and I think a lot of you out there have been liking that. So are we in a cyclical or a defensive type of market? Well, at the moment, we're in, of course, a cyclical type of market, which again shows you growth, shows you expanding GDP, shows you the market believes there's growth in the horizon. Defensive's increasing by a lot. Well, that's going to have, more concerns in the markets. So for now, it's really just, strength. I would keep an eye on utilities, though. I think utilities, whether it's right now or it's the next couple of years, I wouldn't be surprised at all to see utilities perform incredibly well, as this so-called transition that we're doing is going to eat so much energy. In particular, AI. Have a look at the energy consumption of that stuff. It's going to be wild. Now, let's have also a look at the 0DTE influence. So I think it's clear that why we've brought them into the show is it's not like when I first got into the market in 2007 and you just had 1 month options. Now you've got weeklies, then you've got dailies, and take a look at the lion share. Now, eventually this is going to create what we call like a flash crash throughout the markets. But you'll notice here that we've gone to a huge amount of 0DTEs, and in particular, puts have increased a little bit recently in terms of overall size. So basically, there's a huge rise here in usage. Puts, of course, increased a little bit recently. And it's very important that you keep a lookout on the 0DTE game, because that's going to be even bigger over the next couple of years, I predict. Election year drawdowns, we've already talked about this. When we take out the outliers, being this one and this one, we get just under about 10%. So 10% is usually where we kind of can correct to. 5 or 6%, which is what we've already got, is perfectly normal though. And this tends to be the kind of way that we play out. Weird stuff going on until kind of June often, then a huge rally from the end of the year in election years that look like this. When we take a look at all of the markets that are kind of correlated, similar kind of like up and down all around here, but then generally bullish. So again, that's bullish. And then we have 2012 and 1976. And in both cases, they kind of followed a similar trajectory. At the time of this recording, we're actually here. So you can see, because of course April, so we're at the back of April. So we usually had a little bounce, then we pulled back down a little bit, and then we rallied forward. A longer term investor is not going to care about that little bit of a pullback. They're just going to see it as an opportunity. I don't think it's like excellent to go and sell everything or anything like that, because in general, these stats do point towards a pretty good election year. And it is very unusual for election years to turn incredibly bearish. And one of the reasons, because there's a lot at stake, which I'm sure you guys are all aware of. Let's go over now what's going on with earnings, because this week I think has 2,100 companies or some obscene amount. I can't remember. It's the second largest overall earnings week, that's for sure. And you'll notice it does kick off on Monday, but really it's after the close Tuesday and after the close Thursday, which will be the two most important stocks. Plenty of smaller tech, though, coming through. And as always, you need to be aware of the expected options moves. So here they are, and whoa, there's some big ones again. AMD plus minus 9, Amazon, $1 trillion companies moving at plus minus 8. Yeah, I can't think of a time when this has been so common. Remember, Meta's moved down 10, Tesla's moved up 10, Netflix moved down 8 or something. Microsoft moved down, then up 5 or 6. Google did like 14 or something. I know one of our favorite stocks at the moment, by the way. Google, Microsoft, and Nvidia, the pillars. This is one of the things, like it's wild moves. I mean, it's obscene when you think about the hundreds of billions of dollars of money flowing through. We've got PayPal as well, a plus minus 9. And then, of course, Apple a little bit less on the expectation, plus minus 4.5. Either way, some of these semiconductors are just going to be wild. And that's just showing you that the valuations must have growth in them. If they don't, and one of them misses by too much, it does create incredibly weak flows, and markets just sell off straight away, waiting for the next earnings season. You can actually lose 20 or 30% of stock off one bad earnings. Let's have a look now at the SPY, because there have been a couple of big transactions. We saw a big one down at 44 down here. Then we've seen a big one here at 32. So basically what that could have been is little sneaky buy here on the SPY, where they've closed the profit at around this zone, which can make some sense. When we take a look at the SSO, which is the ProShares Ultra S&P, you'll notice just at the close here, or just after near the close, we got two large transactions at these highs. Now, is that a profit take? Is that something else? Well, we put 2 and 2 together with both of them. You can already see the key zones. And of course, as we mentioned before, that 50-70 will be key for the bears. So if we keep pushing higher, they're probably just entries. If we start pushing lower, then that's when you react to that. And it was a lot of transactions across the board. It wasn't just like, oh yeah, we've got one transaction. There were a lot of proxy ETFs all trading at fairly large rank numbers, which basically means that we had a lot of activity right near the close there between either bulls or... So let's talk about the elephant in the room when it comes to central bank policy. And of course, that's the Bank of Japan, often experimenting with how far QE can go. They now own somewhere between 60 and 70% of their overall bond market. If you want to know how far things can be pushed, really the Bank of Japan is the one to look at. But you'll notice here that they didn't come and intervene in their currency, sending it skyrocketing and making it the best time for anyone outside of Japan to possibly visit them to get some cheap rates and some cheap food. I've got to say, one of the things, 158, I would have never thought we'd be at these levels. But this is an intervened currency. So basically, at some point, they'll come and floor it, similar to what they did last year. And that will lead into, of course, potentially drastic losses and huge amounts of gap shifts. Somewhere around this 159, 160 is where the expectation that they'll step in is. And that's why the market moved so drastically and so quickly to that point. Keeping a lookout on this. Of course, this is the experiment gone wrong in terms of central bank policy. And eventually, I think this will become a huge problem, though every single economist has known this for a very long time. So it just shows you can be wary of something and look at it, but that doesn't mean that you should necessarily be trading it. Bank of Japan, one to watch at the moment, out of control. And of course, we'll be watching it more in the future should they have to intervene and push it in a different direction. It may have some effects on the US economy as well, or bears. Let's talk VIX. Did we enter into the green environment yet? Well, we closed right on 15. And as we've talked about, close under 15 will be important. Generally, when you get spikes in VIX, you want to see it come down to around 15, 16 as possible. And then you like to see it spike back up again with the bears taking control. Look where we are. We're at 15. So there we are. If we have a look here at the overall options yield environments with the bonds, then the bonds spiked up a little bit, but still, not really showing super signs of stress yet. Our other bonds market shows that it's still all green, all good in terms of buying dips. So that's pretty nice. And central bank liquidity is dropping. So central bank liquidity is continuing to kind of slide after what we saw, which was that seasonal kind of slide. We're getting more sliding in the central bank activity. Now, that can lead through into the markets over the longer term, so we'll see how that plays out. Where are the best sectors right now? Well, as we mentioned, commodities have been improving. You can see here commodities actually picking back up after their nice rally, DBC. We're also noticing that rare metals in particular are doing very well. Copper flying. It's become the hottest thing, I think, in the markets at the moment. So we've been on this for a while, but copper's doing very, very nicely. Watching 473 at this stage for copper this week. I think it'll probably run into that zone with pullbacks to be met by bull demand. Now we move over to the dollar. Now, can anyone say flag? It's actually a pretty good looking flag, maybe too good, but the flag's happening right just before the resistance top. Now, if it does break through and we get through that kind of 10680, 107 zone, then dollar could really strengthen for quite some time. I've already said it before. I do think dollar will weaken over the next 18 months. But of course, that's a forward prediction. I often say don't do that. But if you have some evidence, you can, I guess. But in this case, that's not a trade. We don't have any reason to say that yet. We have a flag. Now, if you take that flagpole, you're going to get kind of decent length in it as well. So we'll see if it can break out. But it almost looks too good to be true from when you look at a flag that looks that nice. You can also see it's long leg doji fest. So 2 weeks of long leg doji shows you that you're right at the peak. The market's happy where it is right now, and we're going to get a playbook sometime soon. So we'll update when the dollar starts doing something. What about gold? Well, we've been talking about it being a little bit more bullish here. Obviously, we've got some good entries in there last week, and we continue to see a series of higher highs and higher lows. So for now, gold's bullish. That's pretty much how it is on the small time frames. We'll see if it keeps going. What about US oil? So US oil is also technically bullish at the moment because we broke through this little supply, and we were, I would say, lackluster through the Friday trade. But yeah, it's technically bullish at this point, small time frames. I'd like to see the great bull zone of 78 a barrel, but we may not get to that point. Weekly, we always like to check the weekly. Weekly, effectively like a little long leg doji. Again, coming off our good bull zone, not at our great bull zone just yet. So we keep watching that particular one and trading accordingly. What about Tesla? Well, Tesla is, I think, could have turned it because of the general sentiment of AI being so strong in the markets. You know, Elon Musk is the master of the pump, and he's come through and he's mentioned everything you could ever throw. He basically threw the kitchen sink at the investors, and that created bullishness. You've got to remember the stock is down horribly in the bull market, and there's a transition away from anything to do with cars to try to claim AI a lot more. So we've got the island reversal, which is good, the positive. So that's the gap down, gap up. We've got volume obviously increasing, which is positive. You've got horrible sentiment, which is positive if you get the right type of catalyst. And then we've got the previously most traded zone. So in this case, I do think there's probably a seller here. So it's another case for, again, why you've got to be so careful of that 5,100 level. Because look at these stocks, and you're going to see some more in a moment, that are all sitting here. Now, they break through. Okay, cool, good time's going. But if they kind of float around this zone and they start coming down, they could be the opportunities that you're looking for in a couple of stocks. So I think that Tesla's at res. Bulls will need to be very careful at that zone. Apple, a little bit of a rejection through the Friday trade. You'll notice here a little bit of a shooting star or pin bar candle. Not much to go off from here. I'm not really too interested in Apple until we get something good. If you bought down at 165, I couldn't blame you. If you're looking for momentum and those types of things, you're probably going to need to wait till 178. So one to watch. Semiconductors versus the SPY, an incredible comeback. Obviously very, very strong here. 20 moving average every single time this thing is bought up. So that's why we said it's a pretty good zone. And if you have a look at SMCI, it's coming back into, guess what? Another res level. So you've got a res level here, 61.8 pullback, previous supports, some kind of supply in here, a gap fill that sits in between the 61.8 and the 75. So definitely the SMCI run might have a little bit more in it, but then maybe a little bit of weakness. 8.9% on the session. Someone would be very happy with that one. The more replicable one, though, was NVIDIA. So we're coming up to the most traded zone. We're coming up to some pretty key levels. As we mentioned, the 61.8 last week looked pretty good after we got that initial rally. And in 2 sessions, let me just quickly measure here, from the low to the high. Wow. I mean, it's just so much money. 12.83%. I know it's done more on the left, but you've just got to marvel at the hundreds of billions of flow in the clown world that we live in sometimes of how much these things go up. And I think it's going to get way more wild with those IPOs on the future horizon. Oz 200 holding its own. Why? Because it's like the FTSE. They're both basically very financial based indices. And then, of course, you've also got very, very, very strong energy focus and commodities focus. Look at the FTSE go. A few weeks ago, we already reported on this strength around here, and it's just been going better and better and better. And I don't expect it to be weak. I think pullbacks met by bull demand. This is a very strong setup for breakout. It looks like that market's doing very nicely. Speaking of markets doing pretty nicely, Chinese market also improving. Take a look at this, guys. Tencent on the right, HSI on the left. You've got to love the volumes. You've got to love the big break. The one thing about Chinese markets is if they really get going, and of course they're not really going yet, they get wild. So you can go back through the history and see what happens. But yeah, it does look like it's turned. Of course, inverse head and shoulders here and break of the descending horror show channel. Now, you always want to see leaders coming through, and this is arguably one of the best companies in China. So it's improving. Why? Well, I think there's an AI play there, and I've talked about it for a long, long time. Let's talk about German 40 here, and it's also improving. Why? Financials, SAP as well, being like 10% of the company, and it had decent earnings, I guess. And you'll notice there's big wicks. So I'm not trading the German 40, but you can't deny it looks pretty strong. It did have a decent trade on it last week. We talked about in this zone. Other than that, it's doing all right. Let's move over to the US 2K now. Very nice level, that 1950-55 area. Looking for a new break high. Again, where are we? We're just at that little bit of res, which you'll notice is supply over here. We're just at that breakout area. And what are we at? We're at SPY 5100. They're all connected, guys. They are all connected. Generally, you're looking at them for a little bit of edge. S&P tends to be the best. I can see why people are bullish here. I want it to break out from this point to continue to the bull. And if it doesn't do that, then of course it's at res. If we look at the NASDAQ, very similar. Previous supports, big level that we talked about before that led to further selling. Now we've rallied back up to it. And I've got like lines everywhere here, all correlating with around this 17,700 to 17,800. So yeah, next 100 points, very pivotal for NASDAQ, just like the S&P. Let's now move over to the crypto world. So Bitcoin, it's kind of struggling. And look, it's just pulling back in time at this point. I still want to see a 30% correction in Bitcoin. And some people out there are going to say, I hate you so much for saying that. I just think it's normal. And you're going to get one eventually. It always happens in all the bull runs. So most traded zone, obviously down to the 52K. At this point, bulls take control level, just failed last week. We're pushing down. It's hard to say that you want to go and short it heavily. I mean, of course, underneath this level, a closure under 60, as we've already talked about, that's very negative. There's no shelf on the left at all on this. But I would say, look, I'm kind of neutralized into it. You've got to pull back in time. You cannot deny the strength of this market. You cannot deny the hodl of the market in general, because there is so many buyers out there eventually on this particular one. But you'll notice here, the wicks were also decently strong. So this week close could be important. Let's move to Ethereum, because I like to look at the alts. Still most traded zone, still watch reaction level. So we kind of picked the topping of this current little bit. I don't really feel very confident in the bull really regaining until those levels are taken, just like the Bitcoin zone. So I think, quite stuck, guys, until we get a breakout either way. And that's sometimes how it happens. A lot of people say in the comments, pick the direction, man. You pick the direction when you actually see edge. And if you don't have edge, you're not going to pick why would you pick the direction? I mean, you're generally going to be bullish, but you must see edge for a trade. If you don't, not every day is going to be an excellent day. And you must learn that lesson, otherwise you'll get your ass kicked. And I know, because it's happened to me back in 07, 08, 09. Yeah, I got taught some nasty lessons over there, especially about gaps, man. When they started the QE, if anyone was there during it, I still remember the QEs, and they were so wild. You were getting like 150 pip gaps in currency, which on the euro in 1 second. And it was just like, everything was just slipping everywhere, and it was horrible. Some people will have experienced something similar if you traded gold through 2020, when Goldman and all the interbank feeds fell off, and I think it was $15 move in $15 to $50 move in gold without even a trade, because the thing just blew up. So you've got to be very, very, very careful about liquidity in those times as well, and always keep an eye on that. All right, let's take a look for the week ahead now. So we'll load through these data results, and as we know, it's mostly about earnings. But we do have some US news coming through. And then we've got here some PMI data coming on Wednesday, this is on New York time, by the way. And then we've got our favorite FOMC statement, funds rate, and press conference. So that's going to be no doubt volatility. Generally speaking, we see kind of weird movements here, then sometimes reversals during the conference, and of course the discussion points. That will be probably the biggest bit of news for the week, along with non-farm payrolls. So have the jobs started to slow? What's going on with unemployment? Are we in stagflation? Another kind of thing that we're looking for there. If you enjoyed today's video, then remember to subscribe and smash that like button, guys. Hit the alerts as well. We'll cover it all this week. And also check out some of the things that we're also doing. We've got a little sale on at the moment as well. So for some of our courses, you can check out some of our reviews if you want to, so you can see if you like it or not. And sign up, guys. Follow us on X. And we will keep bringing you the best content we can. Love it. Have a great weekend. Bye for now.